All right, let's get started. Hello, everyone. I'm Chris Doerksen, and I'm joined here by Kimberley Anderson. Kim and I are both partners at Dorsey and Whitney, where we work with many resource extraction issuers on their SEC disclosures. In today's webinar, we'll be discussing the new form that most SEC reporting resource extraction issuers will be required to file annually with the SEC in order to report their payments to U.S. federal and foreign governments. But first, a few initial housekeeping matters. The materials themselves and the attendance form for today's session are available for download from the reminder email that you were sent. We will also put links in the chat function so that you can pull those out along with the CLE code for states that require a code. We will be applying for CLE in the jurisdictions listed here. We will also apply for CPD credit in British Columbia, and anyone interested in CLE credit in these states or CPD credit in any Canadian jurisdiction, please return a completed attendance form to attendance@dorsey.com. If you'd like to ask a question at any time, we've enabled the chat feature and you can submit your questions by chat. And if time permits, we will try to address all questions. And then after today's program, we'll send out a survey and hope that you complete that to provide us with some feedback. Next slide. And our contact information is on those slides, and you can follow up with us afterward if you wanted to have any further discussion on these topics. For agenda, first, Kim is going to provide an overview of the new filing requirements, what has to go into the new form, how to comply, assuming that the form does apply to you. Then I'll be discussing an alternative reporting regime that companies are allowed to use if they are subject to this similar type of reporting in Canada or certain other jurisdictions. And then lastly, Kim and I will discuss some exemptions and some special situations. With that, I'll turn things over to Kim.
Well, thank you for joining us today. We very much appreciate it. So if you're thinking to yourself, either, gosh, I thought this happened a long time ago, or I'd completely forgotten about this, yeah, don't worry, you're not the only one. So keep in mind, this started back in 2010 when Section 13Q of the Exchange Act was adopted. So it took years, and then we finally got rules in 2016. Then Congress disapproved them, which they have the right to do under the Congressional Review Act. So then they have to propose them for a second time, but they have to be substantially different. So you can't propose the same rules. And then final rules were adopted in December 2020. They were effective in March 16th, 2021, with a very long transition time. That transition time has now come to an end. So we wanted to discuss with you what those reporting requirements were going to look like. So we have the transition time. And at this point, if you are subject to these rules, let's just talk about timeframes here for a moment. Issuers are going to be required to annually submit a Form SD, specialized disclosure, no later than 270 days following the end of its most recently completed fiscal year. Now, there are some delays in reporting that are permitted, as well as some other exemptions. We'll be dealing with those later. So, for example, an issuer with a December 31 fiscal year end will have to file their Form SD by September 26th, 270 days after the end of their fiscal year. And it applies to that prior fiscal year. If you are, and we actually had a client that had this issue, if you're with a March 31 fiscal year end, because keep in mind, these went effective in March 16, 2021, you are required to submit your Form SD by December 26, 2023. If you have a March 31 year end and you did not do so, we're happy to discuss with you later, but nonetheless. So for people with different fiscal year ends, these can be coming up, but essentially 270 days after your fiscal year end. All right, so let's talk about who is actually implicated here and what needs to be filed. And we'll go through some of the big rules. The benefit of, remember when I said that under the Congressional Review Act, the first rules were essentially disapproved, which meant they were kicked out. is that when they came back with new rules, they were more lenient and more flexible. So we're not going to go through the differences in the rules, but just know that you benefited from Congress stepping in. So a resource extraction issuer, you have to satisfy two prompts. You have to be engaged in the commercial development of oil, natural gas, or minerals. Okay, that means exploration, extraction, processing, and export of oil, natural gas, minerals, or the acquisition of license for any of those activities. So you have to do that. You also have to be required to file annual reports on Form 10K, 20F, or 40F with the SEC. In other words, you have to be a reporting person. If you are only reporting under crowdfunding or Regulation A, you are not subject to this. It's only if you have to file one of those annual reports. And I know for those of you who represent, a lot of MJDS issuers that file on 40F, it's like, yes, there is no exemption. You are stuck with this. So, all right. So what this means is that it's going to require the filing of an annual report to disclose payments made by the issuer or a subsidiary entity controlled by the issuer to the U.S. federal government or a foreign government for the purpose of that commercial development, which we had discussed above. Controlled entities, because it says an entity controlled by the issuer, this is not sort of the SEC's broader definition of control. This is a very specific definition of a control that includes consolidated entities under US GAAP or IFRS, okay? So if you hold only a proportionate interest in an entity, you are not required to disclose the proportionate amount of payments made by that entity. We'll be discussing some of these in a little more detail, but generally speaking, when the SEC was looking at it, the concept of proportionate entities, there was a concern that you might have either double reporting or that if you have an operator who really normally takes care of all the payments, they might have to share, a lot of some of the financial data more than they might otherwise if you were going to make non-operators who had proportionate interests actually report. So that was one of the reasons that proportionate interest in entities, that was not going to trigger reporting. So report is actually, it should say furnished on a Form SD, and it does not have to be audited. So the information is considered furnished, not filed with the SEC. So it limits your liability. This is not going to be one of your liability documents with the SEC. It's not part of the 10K, et cetera. And then there are exemptions for certain issuers and certain kinds of payments, but we'll discuss that later. But let's go into the meat of what is actually required. So what is contained in the body of the Form SD? The body of the document is going to be very possibly 3 pages long. It's going to have a cover page, like many SEC cover pages. Under the headings, you'll have under item 201, you include the following paragraph. You have to include that caption, and then the specified payment disclosure is included in an exhibit. So the body is really nothing there other than a cross-reference for most circumstances. And then under the item 301 is an exhibit list, which includes the payments report, which we're going to be discussing. And then you have your signature page. It is not signed by the officers and directors. It is just signed by a representative of the company. So any executive officer can typically sign it. But unlike the 10K, it does not require director signature. All right, so what is contained in the Form SD exhibit? Okay, so this is where all the meat is. And we expect that most people who are going to be doing this will be providing this information in a tabular format. It is not required to be done that way, but why make life harder on yourself? So the SEC is actually expecting that this will probably be presented in a tabular format. So first, it's going to be the type and total amounts of payments by payment type, and we'll get into what those different payment types are for each project relating to, again, the commercial development. The type and total amount of payments for all projects made to each government. So that one is going to be government specific. Total amount by payment type, currency used to make the payments, fiscal year, which should be your prior fiscal year, but there are some differences there, and Chris will go into that. The business segment of the issuer that made the payments. And essentially, make life easy on yourself. What this means is it's the business segment that's consistent with the reportable segment for purposes of financial reporting. So if you use business segments in your financial reporting, it is that business segment. Governments, and we'll be going into this, including any foreign government or the US federal government that received payments, and the country in which that government is located, because it may be a subnational government that you're paying. The project to which the payments relate, and we'll get into that. Project is a much more broader definition than it used to be. The resource that it's subject to commercial development, method of extraction, and then the major subnational political jurisdiction of the project. So what it's really trying to get at here is very clear, is the goal of this is transparency, and not just for people looking at you. It is also transparency for governments, so that people can understand how much these payments are actually going to governments in foreign countries. Some NGOs consider this a way to be able to hold governments accountable for the amount of money that's coming in and so on. So this is more easily tracked. All right, so now we're going to go into some useful definitions. First, what is a project? This is actually the primary benefit of the disavowal of the current ones. It's a much broader definition. So this project definition is not based on a contract or a lease, unlike the prior one. This one, a project is defined by 3 criteria: the type of resource being commercially developed, method of extraction, and the major subnational political jurisdiction where the commercial development of a resource is taking place. So, in other words, all activities within a major subnational political jurisdiction can be treated as a single project. So if you do, say, copper mining in, province of, Namibia or Nevada, anywhere, that can be a single project, even if you have multiple mines. If you have projects that are both onshore and offshore, particularly if there's natural gas or oil extraction, those cannot be described as a single project. Offshore and onshore, nope, 2 different projects. But if there's an activity, let's say that you have a project that actually crosses the border of a major subnational political jurisdiction, they cannot be treated as a single project. So when you hit that subnational district, like in Canada, a province, if it crosses 2 provinces, 2 projects. So when I said before where it says the type of resource being commercially developed, this does not mean that, like, if you have oil and natural gas in a particular project, which is very common, that doesn't mean you have more than one project. Or if there's multiple types of minerals that are extracted from a mine, it doesn't mean you have multiple projects. We'll get into that reporting, but that's the broad definition of the concept of a project. What is a payment? Okay, let's be clear. Virtually everything is going to qualify as a payment. So essentially, it has to be a payment that's made to further commercial development of oil, natural gas, or minerals. Okay. It is not de minimis, and we'll get into what not de minimis is. And it is one or more of the following. So things like taxes. Now, the concept of taxes, it includes taxes on corporate profits or income when those are made, when those taxes, are made when it relates to the further development of oil, natural gas, or minerals. So it can be, if you pay taxes for income taxes, and this is what you do, that would include taxes, royalties, fees, production entitlement, different bonuses, dividends, if they're paid. Now, keep in mind, if a government is like a common shareholder and you pay dividends to all of your shareholders, and so they're treated no differently, they just happen to own some of your stock, you don't need to worry about that. That is not really a government payment. That is simply a dividend to your shareholders at large, and they happen to be a shareholder, so that wouldn't count. Infrastructure improvements, if those are things that relate to this development, community and social responsibility payment, which are very common in a number of contracts in many jurisdictions. All right, so what is not considered de minimis? So it has to, any payment that's going to be made that equals or exceeds US $100,000, or its equivalent, but essentially it's measured against US $100,000, whether it's a single payment or a series of related payments. So, all right, now, also, which governments trigger reporting obligations? So it's the US federal government. We know which one that one is. And then the following types of foreign governments: national government, department, agency, or instrumentality, And then a foreign national, subnational government, if there's a company that's actually, owned by the national government of a foreign country. So those are all the types of foreign governments. Now, that can also include Aboriginal, indigenous tribal governments if they are considered subnational governments of foreign countries. So payments to those government entities would be included. In the United States, you do not count a US state or tribal entities, Aboriginal entities, et cetera, are not included. So if it's a US governmental agency, it has to be the US federal government. When foreign governments, it's a very, very broad cross-section of governments that will trigger these definitions. And for those of you who are thinking, well, it doesn't seem fair, well, we're the ones who wrote the rules. We're kind of busybodies. All right, technical reporting points. What currency is used? When you're reporting these, you can report in one of two currencies, either US dollars or your normal reporting currency. So if you typically report in Canadian dollars, you can report these in Canadian dollars. That is fine. So if payments were made in a different currency, you have to use one of the following currency conversion methods. There are three, they are specific. You have to pick one of them and you have to consistently apply this, okay? And you will be disclosing this method of currency conversion and it has to be used for all. When we say consistently applied, if you're also counting for things like, oh, how do I calculate if something counts as a de minimis payment? You will be using this exact same currency conversion methodology for everything. So for everything in that Form SD, pick your conversion method and stick with it. For example, it's going to be translating expenses at the existing exchange rate at the time the payment was made, weighted average over the period, or based on the exchange rate at the end of the issuer's fiscal year end. Whatever you think is going to be easiest, you just have to make sure that it is applied consistently. All right, how are locations organized? So what you're going to end up using is what's called the International Organization for Standardization Code, specifically what's called ISO 3166. So when you are looking at a location, that's what you're going to look at. So you will end up using the combined country and subdivision code if it's available. If you're just identifying the country in which a government's located, you have to use the 2-letter country code provided by ISO, again, if available. So in other words, this is going to be your first reference. So if these things are available in there, and that's the first place to check, that is what you're going to use. So let me give you a couple of examples. If it's going to be, a project, it's like in the city of Timika in Papua New Guinea, Indonesia, it would be identified as occurring in Papua without identifying the city because you're going to be looking to the major subnational political jurisdiction. Or if it's going to be a project in Elko County, Nevada, it would be identified using Nevada because that is the next major subnational political jurisdiction. So when you're looking it up, that's going to be the reference and that's what you're using for reporting. All right, now, if something is offshore and you're wondering like, offshore, it's just like, of course, there was actually quite a bit of back and forth with a number of commentators as to how you actually report offshore. So essentially what you're going to be doing is you will be, so let's say you have an offshore project in the Gulf of Mexico. And so, or wherever you want to say, it's going to be where the commercial development is taking place is going to include, it'll be listed as offshore, and then you'll include the body of water where the project is located. And you want to use the smallest body of water applicable, okay? So whereas under other locations, you would ignore the city and focus on the county, here you're going to use the smallest identifiable body of water to identify it, as well as the nearest major subnational jurisdiction. If it's equidistant from two, you have the option of listing both. So, and as we noted before, offshore and onshore projects cannot be combined as one project. Entity level reporting. So some kinds of payments are made at the entity level, not the project level. So if you're a company with multiple projects, but there are certain kinds of payments that are paid at the entity level. For example, if there's going to be a tax on, depends on if it's income tax reporting or otherwise, certain kinds of reporting, it would then be disclosed at the entity level. So really what it comes down to is you would end up reporting those, but simply omitting certain kinds of tags, like the project tag, the business segment tag, because those are provided at the entity level. So just because they're not provided at the project level does not mean they have to be reported. It is simply going to be reported slightly differently. And for those of you who have gone through XBRL tagging, particularly those of you in financial reporting, know that it can be difficult sometimes or miserable sometimes. Because this is going to be a whole new one to go through, you will, of course, want to make sure that you give yourself time to identify what the appropriate tagging is for the exhibit. All right, project reporting. So what are we talking about with the project? So first, it's going to be the type of resource being commercially developed to identify the project. So you're going to want to, and realistically speaking, for commercially sensitive information, well, I expect that most issuers will want to define project as broadly as possible within, as permitted by the rules. So also just to make life easier for you, because one of the concerns initially was that if you have to identify things on a very granular basis, it makes it harder to comply. And in fact, it also means that you could have to reveal some competitively sensitive information. So the definition of project is broader. So first is going to be the type of resource, such as mineral, oil, or natural gas. So you really only have to give sort of the broader definition. So for example, you just have to describe oil, not heavy crude oil. So you don't have to go into, really detailed specifics. But for example, if there is a project and you have both, gold and silver or, zinc, and you have a variety of metals that are being extracted, you would list them all. Okay. So in case, and then again, minerals are similar. You list them by type. Additional detail is not required. Now, for those of you who are wondering, like, okay, so what qualifies as a mineral? If you're on here, I'm guessing that most of you are aware of what 1300 is, SK 1300, which is reporting. It looks to that for the definition of a mineral. All right, synthetics. That's what I must admit I found kind of funny. So if it's synthetic oil that's obtained through tar sands, you're going to report the resource as oil. If it's gas obtained like methane hydrates, it's reported as natural gas. However, if you get synthetic oil or gas obtained from processing coal, it's now identified as coal, which I find, I don't know why that amuses me, but nonetheless. So it's, if you are, so if that's what you're dealing with, if you're dealing with synthetics, there is guidance on that point. Method of extraction. This is the simplest way possible. It's one of three. You only have one of three choices. Well, open pit or underground mining. If you have perhaps both open pit and underground, you simply list them both. You do not need to go into more detail than that. So that's it. It's one of three categories, and that's it. And you can list, as we said, more than one. Location of the project, we discussed that before using the ISO numbers. Payment reporting. So payments are going to be during the prior fiscal year. So it is for that fiscal year period. And we discussed before the various different categories. So the amount of payments for each payment type. So in other words, the total amount of taxes you paid. And then total amount of payments for each project and each government. So in other words, if there are some subnational governments that, they each got certain things, you will have to identify the totals for each of those. They are reported on a cash, not accrual basis. So that is, just want to make sure that you're aware of it. It is the payments of when those cash payments and those payments are made. So that's how this is being calculated. I'm going to turn it over to Chris. He's going to discuss some exemptions as well as alternative reporting regimes, which I think many of you are going to be very pleased with. And then we'll go through some exemptions and some additional special situations. Chris?
Well, before we get started on alternative reporting, why don't we just take a step back again to timing for just a moment. So as Kim mentioned, it's 270 days after your fiscal year end. And so the deadline will depend on your fiscal year end. The first people who were required to report were people with March year ends, and they have already been required to report. If you have an April year end, you're going to have to file this month in probably a couple weeks, and then it kind of goes from there. So December year end companies are some of the later filing people. And another thing to understand is it's 270 days. It's not 9 months. So don't assume that you can file on the last day of that ninth month, because several months have 31 days. It's actually going to be a few days before the end of the month for just about everybody. And so want to just correct one thing. I think we had said that the December deadline would be September 30th. It'll actually be a few days before then most years, and it will vary from year to year depending on exactly whether it falls on a weekend or not. So just assume you're going to subtract a few days from the end of 9 months for your deadline each year. Okay, so now alternative reporting. All the Canadians on the line will be very happy about this section because your mind's been blown about all this stuff. But basically, the SEC, as part of the rules, allowed that the SEC could identify a foreign jurisdiction's equivalent regime as being sufficient to satisfy the objectives of the US statute. And it has done so. Let's go to the next slide. So at the time of adopting these new rules, the SEC specifically approved ESTMA from Canada, as well as the EU directives, the UK's equivalent, and Norway's equivalent. And let's go to the next slide. What does this actually mean? So this means that if your company is already filing under one of those specific regimes, under the rules, you will be allowed to use that as the basis of your Form SD. So you still have to file a Form SD, but the level of detail that Kim just went through, you will be exempt from that, and you can file a copy of your foreign report as the exhibit in lieu of what the SEC content for an exhibit would be. And so here's an example. So for an example, if you are listed on both the TSX and the NYSE, and because you're listed on the TSX, you have to file under ESTMA. We believe that the ESTMA deadline is 150 days after the year end. So you'd first file in Canada under ESTMA, and then right after that, or you could take longer, but you'd have up to the 270 days to file your Form SD with the SEC, and that Form SD would attach your ESTMA report in English with the XBRL tagging that Kim described, and you wouldn't have to go through the different analyses that Kim had discussed in more detail. Next slide. So one interesting thing is, often when the SEC has exemptions like this, they may say it's only available, if you are a non-US company or something like that. They did not do that here. So if you are a US incorporated company and you file an ESTMA report or a UK, EU, or Norway report, you can rely on this, even though you're a US company. So this will be, we expect that probably most Form SD filings will be ESTMA reports, probably, just given the number of Canadian companies that are cross-listed and the number of US companies that are listed in Canada as well. But what will the report actually look like? So this outlines that. It'll be similar to what Kim mentioned, so still have a cover page. But under item 201, you instead have to include this specific information if you're going to rely on alternative reporting. So you have to state that you are relying on the alternative reporting provision. You have to identify which specific reporting regime the non-US report that you're relying on was prepared. So if it's Canada, you would say, the report was prepared under ESMA. You have to describe how to access the publicly submitted version of that non-US report in the alternative jurisdiction. So for example, you would identify, the governmental website where one can go and pull your ESMA report. And, for many companies, you'll have more than one way. So you may also have it on your issuer website. So you would identify that as well. And then you would specify that the report is attached as an exhibit to the Form SD. And in the exhibit itself has to be the entire non-US report. If that report was in English in the first place, that's pretty simple. If that report was not in English, but in French or Norwegian, then you would have to translate the report. And what you would file with the SEC is a fair and accurate translation into English of the entire report. Of course, when you're cross-referencing where to find the original report, you would be cross-referencing the foreign language version of it. But in the SEC filed version, it would be your English version. And so this makes the report fairly simple. You can see on the SEC website that there are a few examples that have already been filed. We've helped some clients already file in some of the earlier tranches of the filings here. And really the work, so if you're a Canadian company or another company that files under ESMA, really the work of this filing is just the XBRL tagging, because it's a very simple form now. You're just attaching something you've already filed in another jurisdiction. And it's the XBRL tagging and just making sure that you contact your EDGAR provider in advance, and you have time to proof the tagging. And in that tagging, you will have to identify each of the minerals. So there may be a disconnect between what is normally visible in your ESMA report and then what has to be included in the tagging. We found that some issuers, for example, had to add additional information in the tagging that was not in the ESMA report itself. Similar to what Kim mentioned, if you had multiple minerals, you have copper, gold, zinc, whatever in that mine, that goes into the tagging. And so some of that information might not technically be in the ESMA report. You'd be adding it on the EDGAR process. Next slide. So the SEC also contemplated, the possibility that one of these alternative reporting regimes might give you a longer period of time to file your report in that non-US jurisdiction. And they tried to make it easier even in that case. So in that case, you can still rely on alternative reporting. And all you have to do is that by the US deadline, you have to file a Form SD that indicates that you intend to submit that alternative report using the alternative jurisdiction's deadline. So just for example, let's say the alternative jurisdiction gives you 300 days and you don't want to accelerate that, then by day 270, you would file the Form SD saying you intend to rely on that alternative jurisdiction's deadline. And then you'd have to file an updated Form SD after your foreign filing. That has to be filed within 7 business days, where you would actually, attach the report as we discussed. And the specific penalty, if you failed to do either of these things, you filed it late or something, is you lose the ability to rely on this accommodation the following year. So it's a pretty liberal exemption. Next slide.
So, but just to clarify, so it would just be for the following year. So let's say someone makes an error in 2024. And so they're either late on one of these or otherwise. So that in 2025, they would have to file a regular Form SD under US disclosure obligations. And then for 2026, they could go back to the alternative reporting if they so choose, right? So you lose the accommodation, what it sounds like under the rules, for 1 year, and then you can go back to losing it again. Then you can go back to using it again, correct?
Yeah, I'm not sure that you lose alternative reporting entirely. I need to go back and check that. I think, but you clearly lose the ability to file later than 270 days.
Okay, My mistake. Okay. Oh,
All right. And next slide. Okay, so now some exemptions, and we're going to go through some exemptions and special situations. And there's several different types of exemptions. So we'll first talk about some exemptions from filing at all in any given year. There are some cases where you don't have to file at all on a particular year. There's also some cases where particular payments may be exempt from being disclosed in a particular year. So where you still have to file the form, but you may not have to report those specific payments in a year. There's both kinds. So first, the ones where you might not have to file Form SD at all. So one is there's a 1-year exemption for someone who has just completed their US initial public offering. And in that case, you are not required to file a report for the fiscal year in which your initial registration statement went effective. So in this example here, if you have a December 31 fiscal year end and you do a US IPO in 2024, the registration statement for that goes effective during 2024. That means that you will not have to do a Form SD in 2025 for that year. Your first Form SD would be for the 2025 year that you would file in September of 2026. One thing that's a little odd here is the SEC did not really define US initial public offering. And so it seems obvious that it would apply if you did a traditional IPO, like you were a private company and you did a public offering that got you listed in the US, and that was the first time you went public anywhere in the world. That clearly would be apply in that situation. It seems like it would very likely also apply if you were public in another jurisdiction, but not the US. And the way that you went public in the US is by doing a public offering in the US. It might be worth getting SEC guidance before relying on it in other situations. Like if all you did was file a Form 40F with the SEC, is that considered an initial public offering, given that you didn't offer any securities? Possibly, but that's something that we may need to get further guidance on for certainty.
or
Next slide.
possibly if you did a Form S8 to register things under an equity plan, that's a Securities Act registration, so that might also trigger it. There are a few things that Chris and I have been discussing that we'll be seeking guidance from the SEC on.
Okay. The second exemption, don't get too excited about this because it's only available if you are specifically not subject to any of the foreign alternative reporting regimes. But if you are not, then you are exempt if you are an emerging growth company or a smaller reporting company. But let's say, for example, you're a small company, you're an emerging growth company, but you file ESMA reports. Well, the SEC is not going to give you this exemption because it'll be so easy for you to just file a copy of your ESMA report with a Form SD, and that's what they'll require. But if for example, you're a smaller US company, you're not listed anywhere else, and the SEC is the only country that requires you to do this type of report, then if you are an emerging growth company or a smaller reporting company, you can rely on this exemption and you don't have to file a report at all. Because the only jurisdictions the SEC has approved right now are Canada, EU, UK, and Norway, this could apply to companies from other jurisdictions as well. Say someone who's listed in China or someone who's listed in Australia might be able to rely on one of these exemptions. And because smaller reporting company, that status relates to, your market capitalization and your revenue. Someone who files on the US domestic forms as a small reporting company could conceivably be exempt forever, as long as they stay a small company. For emerging growth companies, companies typically lose that status after a while. if you haven't lost it for another reason, you would normally lose it 5 years after your first US, registered offering. But there could be some smaller US companies that can use this exemption for a very long time. Next slide. All right, so next I'm going to talk about 2 exemptions where there's conflicts. So the first is conflicts of law. So what do you do if you have a project in Yemen, just to pick a country, and Yemeni law provides that it is illegal for you to disclose this payment? Well, you may have an exemption. So this exemption is limited to a situation where the disclosure of the payment information is illegal under the law of the jurisdiction where the project is located. So it has to be the jurisdiction where it's located. It can't be some other jurisdiction like your incorporation jurisdiction. And then to take advantage of the exemption, you have to take all reasonable steps to seek relief, to the extent any steps are potentially available, and you have to be unsuccessful. You still have to file the Form SD. You have to disclose that you have omitted some information. You have to describe the law with particularity that makes this disclosure illegal. You even have to get into all of the efforts that you did to get relief. And then you also have to attach a legal opinion of competent counsel, that confirms that you actually cannot disclose this under that applicable law. So it's at least puts you in a position of not having to violate your, the law of your mine location or your drilling location, but it's a pretty high standard, so that people can't abuse it. Next. Now, this one is a similar exemption if you have a contract, and it has to be a contract that predates the effective date of the SEC rules, which you may remember from earlier was March 16th, 2021. So if you have a pre-existing contract prior to that date, similarly, you can exclude the information, but only if you've taken all reasonable steps to modify or waive that contract term, and you include the same type of information. So detailed disclosure about the omission, the efforts that you took to try to change the contract or get out of it, and attaching a legal opinion of counsel that confirms, your interpretation. Next. Now, there's also a partial exemption here if you have recently acquired a company or control of the company. So say that you are already subject to SEC reporting on this, and you acquire a new company that was a private company, and that private company was not previously required to disclose this type of information, you are allowed to omit the information relating to that acquired company for the year in which that acquisition closed. So, for example, if you December year-end company, you complete an acquisition during 2024, then your report that relates to 2024 that you file in 2025 can, if you would like, omit the information regarding that acquired company. If you intend to do that, you do have to disclose that you've relied on that exemption in your Form SD that you have filed. And then importantly, this exemption is not available if the acquired company was subject to either, Form SD in the first place or any of the alternative reporting regimes. So, if you acquire some other, smaller Canadian company that files under ESMA, you'll have to include their information in your report, and you don't have this exemption. I think just so we didn't make assumptions, just to be clear, these exemptions we're discussing, the partial ones, obviously don't apply if you're using alternative reporting. If you are relying on the fact that you filed an ESMA report and attaching the ESMA report, you'll just attach the ESMA report. That's what you have to do to use alternative reporting in the first place. So these partial exemptions apply, assuming that you are following the SEC disclosure standards. Okay, next. And similarly, if you're following the SEC standards and not alternative reporting, there is a 1-year ability to defer disclosures relating to exploration activities, with definition of which we've included here. But if an expense was related to exploration activities, because of the sensitivity of, a competition for newly found locations, the SEC will not require you to disclose that for that year. You can wait an additional year. So for example, if you, paid some fees to locate some new mining claims in, let's say, Arizona in, 2024, you could omit that from your filing for 2024 that you file in 2025. You could hold that over for 1 more year. And then, in that report that you do the following year, so you get almost 2 years basically to wait until you disclose it. And when you disclose it, you would just disclose when it occurred. So people would see that, oh yeah, that was a payment from 2 years ago. But you can do that. You're not required to.
You just have to remember that if you do omit it, that for 1 year, that you have to remember that you do need to disclose it next year. You just have to make sure that with respect to that internal control, that you are tracking when those payments would then be due. So.
And then the last exemption we'll talk about is this general one. The SEC is allowed to make exemptions on a case-by-case basis. We're not aware of any just yet because most people haven't been required to file at all. But this, could be used perhaps in special cases where there's particular issues that the SEC hadn't initially considered.
Now, and this would also have to be disclosed on Form SD. So even if you get this exemption, you would have to indicate that you have applied for that exemption. So you may be exempt from having to make the disclosure, but it doesn't eliminate the Form SD because this would be required to be disclosed in the document.
Now, I'll turn it back over to Kim. Kim will discuss some special situations.
Okay, so the SEC and various commentators, spent some time thinking about joint ventures and how they should be reported. Some of the concerns related by people who are operators, concerns related by people who are not operators, and how they would be able to get this information. So fundamentally, what they decided to do is, in most instances, the operator will be doing the reporting. So, or if one party has control and it's consolidated, then that, of course, that party will be doing the reporting. But let's say you have a joint venture where no one party has control, a 50-50 joint venture. And so no one consolidates. So essentially what will happen is that if you have someone who's a resource extraction insurer and they're the operator of the venture, and they make payments to governments for the entire venture or arrangements, they're the ones who have to report all the payments. So they'll be, so if the $100,000 worth of payments, because of that joint venture, they would report all of it. So if the non-operator members are required to reimburse the operator, that's not reportable because all of those payments have now been captured by the report by the operator. Now, however, if a non-operator member is required to report payments that if they are also a resource extraction insurer that they directly make to governments, those are required to be reported. So, if for some reason the two members have separate payment obligations, those would have to be reported. Another one we want to talk about is service providers. So generally speaking, first, let's go back to basic principles. Let's say you are a bubble company and you provide, like drilling services, or otherwise, or hydraulic fracturing services to other companies. Your job, and you are not part of commercial development. So you're not a resource extraction insurer unless you otherwise are, but providing those services doesn't make you a resource extraction insurer. However, sometimes there will be companies that will effectively operate project. So, but if you were someone who's operating like and they are making payments, acting as a third party agent or a broker. So if they're making payments on behalf of the owner of the project has to disclose the payment. So that payment, so even if someone else is actually making that payment, if they're doing so as a third party agent or broker, the actual resource extraction issuer, one who owns a project, has to make that payment. It is not an obligation for the service provider to actually make that report. One other issue, since we've got a few minutes left. Sorry, royalty companies, one more. So royalty companies are not required to file Form SDs if they don't engage in commercial development. As we discussed, that's the exploration, extraction, processing, export, or otherwise. So if they're not, so in other words, if they are essentially royalty companies, they passively hold these royalties. This is not going to trigger those payments, because keep in mind, royalties and other payments would be then completely satisfied and reported by the resource extraction issuer itself, not royalty company. So you don't want to essentially double report. We would not anticipate that, unless a royalty company also engages in commercial development for itself, that they will not be filing a Form SD.
And one reason why we put that slide on there, though, is for royalty companies to consider if there's any chance that they could be offside due to incidental activities. So,
Right.
Sometimes royalty companies will acquire asset sets from people that are primarily royalties,
Yeah.
but might include, perhaps they're buying a company that principally owns royalties, but that company happens to own some mining claims or some, exploration licenses on the side. You want to be careful in that situation that, then you have acquired, these types of rights that are captured potentially if there's any further payments that you make after that acquisition date, before you terminate or resell them.
There are some, another instance, which we didn't cover in the slides, but if a resource extraction issuer has a subsidiary that they control, but is in and of itself a resource extraction issuer, the parent can report for both entities, and it would have to disclose that it reports for both entities. That would not prevent separate reporting, but you can do combined reporting, if that's permitted. One thing that Chris and I have discussed that we also want to reach out to the SEC on is what about situations, possibly with respect to either, acquisitions or otherwise, if there are ESMA reports filed with respect to certain aspects of a project and not with others. Can you essentially file a Form SD that combines ESMA and non-ESMA reporting? We don't know that. We have been trying to go through sort of all the different permutations that we can think of before we hit a crunch time with respect to reporting. So in fact, if any of you have specific questions about fact scenarios that you are concerned about, one, we can, of course, help advise you, or if it raises a question that we just don't think the SEC has yet considered, which is always the case, there's always additional guidance provided. You can always, reach out to the SEC, or you feel free to reach out to us, and because we'll be probably submitting some questions to the SEC as well, as we kind of go through and get closer to some of these reporting time periods, because, unlike, because there'll be reports that are going to be filed throughout the year. So I expect that some of the questions that he and I have been discussing will probably submit fairly quickly.
And we've been tracking questions as they've been coming in. If there's any other questions that you haven't raised yet, please submit them in the chat right now. We've still got a couple minutes if you can type quickly. But to deal with a couple that have come through already. So we had a question about the differences between ESMA and the SEC standards, which that question came through before we got to the alternative reporting. So just to confirm on alternative reporting, because ESMA, reports can be relied upon, we presume that, most companies that are subject to ESMA will just file their ESMA report, and then following that, file the SEC Form SD that includes the ESMA report. There's really no need to wait, the additional 4 months after you've filed in Canada. Probably as easy as just to file in Canada, then file in the US, maybe either same day or the next week or something like that, just to get it over with.
Yeah, depending on when you get your tagging done. Yeah.
Yeah. Second question, which I'll push over to Kim, which was, again, I think this was maybe asked before we got to that slide, but just to confirm, are Indigenous governments included in the definition of government?
So if they're Indigenous governments in the United States, no. If they are Indigenous governments in foreign countries, then yes, they are.
Okay, and then last question, we had a question about whether this is being recorded, and it is being recorded, and we anticipate that it will be available online probably in a few days for people who may want to share it, or if you only were able to see part of the presentation or wanted to check it again, that should be available in the coming days.
And as a reminder, if you want credit, please feel free. Well, we encourage you to fill out the attendance sheets and send them back so that we can send to you your certificate of attendance.
Oh, and we got a new question, question from someone who is now no longer reporting under ESMA, but is now reporting under the UK regs. And can you file the UK report as an exhibit to the SD? So it is clear that if it is the SEC reporting entity that has filed an alternative report, including the UK report, that you can file that as an exhibit to the Form SD to satisfy the US requirements. One thing that Kim and I were just discussing earlier and is not 100% clear is if your alternative report is not by the SEC reporting entity, but only by, say, a subsidiary, the rule itself is not clear that you for certain could rely on that report. That may be something that we need to discuss further, about, does that report cover all of your projects or only some of them? And, would the SEC allow you to use it? I think the case would be certainly stronger if it covered all of your projects.
Yeah.
And so nothing would be missed. I expect they would be sympathetic, but that's something we'd probably need to confirm.
Mm-hmm. And I think it's, my clock shows 11:59. If there's, any other final questions, please, you can also feel free, again, to reach out to me or Chris. Our contact information is there. Otherwise, you can also find it on Dorsey's website. And I'm guessing many of you probably already have it in any event. But we really appreciate that you are spending the time with us. And we look forward to working with you. This, I think, is probably going to be the less onerous of new SEC reporting obligations. So